Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay. So, I don't know, Steve, do you want to take, if there's any questions on that, is there anything you want to add to that before we look at using a combination here? Or
no,
anything?
The only thing I would add is that, sometimes I like to teach that when you're buying options, you want to be really right or really wrong.
Okay.
And that's really, when I say really wrong, it's because, well, yeah, as Jason said, you have the ability to close out your position, but you really need movement. I mean, the worst case scenario is that you buy this option and it hangs right at that strike price that, or whatever, at that pair value that when you first put the trade on, then you really don't have a chance to make money. So you need a move, and that's the first thing that we all should be thinking about. If you think that the market's going to move in a big way, well, then buy calls or puts. If you think the market's going to move in a more moderate direction or magnitude, that's going to sort of lead into Jason's next bit of slides.
Yep,
combinations or spreads.
Absolutely, good stuff. All right, so we mentioned about combining options to help offset the cost and lower your risk exposure and so on and so forth. And while there's a multitude of different combinations that one can use, the sort of the next logical step from buying a call, buying a put, is actually creating what's referred to as a debit spread. And the benefits of a debit spread are really quite simple. Number one, it's going to lower the cost of your initial trade, so consequently you're limiting your risk exposure. And then further to that, you're going to be able to take advantage of and help offset the option volatility. So right now we're trading in a market where options volatility is extremely high, and consequently if we're an option buyer, okay, we're going to pay for that volatility. And now that volatility is placed in there because these pair values, just as in the equities market where the stocks have been making very, very significant moves over the course of a short period of time. So when we're using a combination, we can actually put that or use that to help us offset some of our initial costs. Now, let's understand the use of a combination, and this really forms the foundation for any strategy, combination strategy that you'll ever look to implement. So once you understand the basics, okay, it's just a matter of combining the basics to build these more advanced and caviar-like strategies. So everybody understands the concept of buying a call option as giving us the right to own the underlying at a specific price. So as an option buyer, we are buying the right to own that particular underlying at a specific price. Okay. Now, that being said, if we look at this as from an options writer perspective, if we sell a call, we have an obligation to deliver at a specific price, okay? Because remember, there's two sides to every one of these contracts. Somebody has the right to own at a certain price, and somebody on the other side has the obligation to deliver. And as long as you know where you sit within this agreement, you can then start using that to your advantage. And we're going to talk about this further in a minute. Let's look at it from a put perspective. A put, as a buyer, gives you the right to sell that particular underlying at a specific price. Okay, so with that said, somebody has to be on the other side of that. So if I've bought the right to sell my security at a specific price, there has to be somebody behind that says, all right, I agree to take that from you at that price. Okay, so when you sell a put option, you are creating an obligation to buy at that specific price. And again, understanding these logistics will help you build these more advanced strategies. So let's look at creating a debit spread. There's two types of debit spreads that we can actually apply here. We can apply a bulk call spread, and realistically what we're doing is we're buying a call option just as we did with our original example, but we're going to sell the higher strike price at the same time to help lower our risk exposure, okay? Because we're buying the right to own it at a specific price because we know we can own it at, for example, 150. We have no trouble delivering it at 160 should the market move towards that or carry on beyond that. Once we own that right, we own that right. And so this is how we can sell that call option, because we have an identifiable risk exposure in that we always will have the right, provided we don't offset our position, we will always have the right to own that underlying at a lower price. Okay? Our bear put spread means that we're buying the put and we're selling the lower strike, okay, to help lower our risk exposure. So by selling the lower strike, we've obligated ourselves to buy the underlying at that particular strike. But because we own it at a higher strike, we know we can sell it, because remember, you buy a put, that's the right to sell. We can sell it higher. So consequently, we do not have the risk exposure on that naked put option that we would if we didn't have that first leg of the strategy. So now let's look a little more closely at a bull call spread. So I've actually selected a 150 option here, but essentially what call option. But essentially what we're doing is we're buying the lower call strike price, and we're going to sell the higher strike, and the difference between the strike prices represents the profit that we can make. So we have a limited risk exposure, but by adding that extra piece of the puzzle, we now have a limited profit potential. Okay, so that actually plays into what Steve was suggesting, that if you have a target on any of these FX options pair values, then you could use this strategy very, very effectively. So if you feel, for example, that between now and in January, the AUX is going to trade up towards the 160 level, then you could actually create a spread. In this case, what I've done is I've used the 152 and the 160. So what you're doing essentially is you're still going to pay the $10.82 for your 152 calls, and that's going to give you the right to own the pair value at 152. But to help offset that cost, okay, what you're doing is you're going to sell the 160s, and you're going to receive a credit. Okay, and the idea, guys, is that if the pair value is trading below 160 on expiration, this is going to expire worthless. And because we're the seller of that option, we've taken on the risk of selling that option, we get to keep that entire premium, which means that it offsets our position such that it now only costs us the difference between what we paid for the lower strike and what we've collected for the higher strike. So the most we can now lose is no longer the $1,082, it's $453, which represents, again, the difference between the premiums that we've bought and sold. Our profit, of course, because remember, when you limit your risk, you limit your reward, now falls between those two strike prices. Okay? So our profit is the difference between our strike prices minus the debit. And to me, this is actually a more attractive risk versus reward scenario than actually buying that straight up call option, because what we've done is we've limited the amount of money that we're putting in. We're no longer putting 1082. We're theoretically putting in $4.53.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.